Hi there and welcome to another video from FundingStore. Today we're going to be looking at business loans with bad credit, i.e. how can a business with bad credit successfully borrow from a financial institution. So if we could start from the top, what is bad credit? Well, bad credit basically means you've got a low or adverse credit score. And what is your credit score? Well, it's basically like your school report. However, it's for financial institutions rather than for school. So if we could take, for an example, a business who generally been receiving a good report or had a good credit score up until 2008, say, when the financial crash and credit crunch set in. And as a consequence, this business may have had his financial report or credit score adversely affected. For example, it may have defaulted on some loan repayments or had them frozen, or for example, payments to creditors started to bounce. So, if this business was looking for a loan for example, expansion or refinance, it may apply but be rejected by, for example, the main high street banks, because the banks would look at its report, i.e. its credit score. They may A, perceive them as too risky, but B, also think due to the economy struggling, there's no guarantee that this company is going to hit the figures they claim they will, or prevent a decline in business. So in this case, now what? So if we start the presentation, if this is you, this is your business, companies often perceive that all other things being equal, if you've got good credit, then you can go on to receive a loan from a conventional financial institution such as the bank, and everyone's happy. And if you have bad credit, then you'll have your application rejected, and as you can see there, you're doomed. Well, this presentation is to show you some of the other options. You're not necessarily doomed. There's a couple of options available to you, and I like to divide them into two. Option one, as I'm going to call it, is you can rebuild your credit score. Well, how do you rebuild your credit score? Well, to start, you need to ensure that you're making regular payments out of your business account, for example, to utilities companies, for example, your phone bill, even small payments to creditors. Even if these are small amounts, the regular on-time payments will gradually improve your credit score, as it's weighted more heavily towards current activity than past activity. So any previous damage that you might have done to your credit score in the past will gradually become less and less important in the overall scoring system of your credit score. So as your score will gradually improve, as you can see in the diagram, you can whiz back up that arrow over there, and hopefully with a better credit score you'll be able to receive loans from more conventional financial institutions at more competitive rates. So that's option one. If option one isn't available to you, for example, if your loan's urgent, you may not be able to or want to wait until your credit score is repaired. You may need the money now. With a poor credit rating, a loan from one of the conventional institutions such as banks is fairly unlikely, as I said, as you're considered too high of a risk to default on your repayment. However, there are other companies, and particularly online companies, that offer different products designed specifically for borrowers with bad credit or subprime borrowers. One thing to note is that due to your perceived higher risk, the rates on offer will be inevitably less competitive, so the cost of borrowing will be higher, as the company loaning to you must hedge against the odds of your default. However, just because the rates may be less competitive than, for example, conventional financial institutions, that doesn't mean that there isn't significant variety between the rates offered by some of these companies. So I definitely recommend looking around to see if you can find the best and most competitive interest rate out of the less competitive interest rates on offered. There are a couple of things to consider when looking at this type of loan. A, you've got to be careful of the terms of the loan. Some of these companies may look for security, not all, but some of them may look for example, personal guarantees, or, for example, home equity, i.e. Securing your loan against your house, or maybe a car or something like that. And if this is the case, of course, you've got to be very confident of your successful repayment, due to the risk of putting your house up as security for the loan. Also, it sounds obvious, but make sure you will be able to repay the loan for two reasons. A, successful repayment will go towards improving your credit score, whereas default will dramatically worsen your credit score and make any future borrowing incredibly difficult. And secondly, if you do default, these loans may have very strict terms and conditions, which will result in the loan costing significantly more in the event of a missed repayment. So make sure you read the small print and always get professional advice before taking out this sort of loan. If one of these non-conventional loans doesn't sound like something for you, there are a number of alternative funding options, one of which is peer-to-peer platforms, the other is merchant cash advances, and the final one is invoice finance. It's worth noting that all of those will still put some emphasis on your credit score. However, they may take into account other things when considering your application. So, for example, with a peer-to-peer platform, you may be assigned a higher risk grade, for example, a C rather than an A, and that would mean that lenders would look for higher interest to compensate them for the risk in lending to you. However, you may be able to secure funding that way. With merchant cash advances, the emphasis would be on how much you collected through credit cards in the past couple of months. So, for example, if you're in retail and took 24k through credit cards in the last month, you may be advanced 24k by the company, which you then repay a small amount on every transaction back to the company. So that's an option. The final possible option available is invoice finance. As with invoice finance, the security is good on reliable invoices, and invoice finance companies at the moment are looking to take on new business, so that may be an option. I hope you found this presentation helpful. As always, if you've got any questions, please give us a call on 01565 756 141 or have a look around FundingStore.com.